This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Learning the alphabet. Google's parent reports a profit slide because of a big European fine. But the underlying business is clicking along as easy as ABC.
Cash is king. Home prices hit a fresh record. So why did one Texas seller with 22 offers decide not to take the highest bid?
Distributors disrupted. Amazon could be going after its biggest target yet, the middleman. Those stories and more tonight on Nightly Business Report for Monday, July 24th.
Good evening, everyone, and welcome. The Nasdaq closes at an all-time record, but we begin tonight with an after-hours slip in the shares of Google's parent company, Alphabet. The stock, which you may own in a fund or retirement account or individually, initially fell by more than 3% when the company reported profits 28% lower than a year ago. Now, that was largely because the company booked a $2.7 billion fine from European regulators. Ongoing regulatory risk is apparently what spooked investors this afternoon. Overall, the business is clicking right along. Net revenue rose 21% to $26 billion. Clicks on ads jumped 52% compared with a year ago. Cloud revenue up smartly as well. Josh Lipton has our report on Alphabet, the world's largest advertising company.
$18.4 billion. That was a big number in Alphabet's latest earnings report. Refers to Google Properties revenue, or revenue generated from search and YouTube. Aaron Kessler of Raymond James says it's critical because that's the highest margin businesses for Google, and that revenue jumped nearly 20% year over year. However, Kessler also notes there could have been some disappointment in the report, specifically with traffic acquisition costs. That's what Google pays its partners for mobile traffic. When that rises, it can pressure overall company margins. For Nightly Business Report, I'm Josh Lipton at San Francisco.
Let's turn now to A.B. Mendez for more on Google's parent company's earnings and the beat there and what he sees ahead for the company. He is portfolio manager at Frost Investment Advisors. He does own the stock. Welcome back. It's nice to have you here.
Thanks, Sue. Good to be with you.
You've held this stock for quite a long time, and you intend to continue to do so, correct?
Correct. We bought Google shares. We first bought them just over a decade ago in June of 2007. A few years after the 2004 IPO, the company has consistently outperformed the broader tech space since then, and in our view continues to be on the cutting edge of innovation, especially around artificial intelligence and machine learning, and also kind of coming into its own as an enterprise cloud vendor.
Are there any nits to pick in this report other than that headline number, which was overall the profits were down because of the big European fine? One of the things that I've seen some people point to is not the number of ad clicks they got, but the price per ad click, which was apparently a little lower than some expected.
Yes, Tyler, it's a good point. The total count of the clicks is growing extremely well. If anything, positive inflection. But the cost per click for now is declining as more of those clicks come from mobile channels, and that's a lower cost per click.
Where would you like to see improvement, or where do you see the biggest potential for this company?
Well, the company is still relatively earning early innings in terms of its international business, the digital media business, and especially the cloud business, where it's sort of in its infancy, maybe where Microsoft's Azure cloud was 2 or 3 years ago. So I'd say specifically look at their own CapEx priorities, and they're spending a lot of money hiring developers on the cloud side. And again, I think that some of that artificial intelligence IP, where they have real leadership, could have very valuable application in that area.
So you like this stock? It's in the high 900s or 900 and something a share. Where do you see it in 3 to 5 years? 998.
Well, it's hard to predict with precision, but we can just say in the decade that we've owned it, it's performed well ahead of the broader market and even the broader technology space. Looking on a valuation basis, it's currently trading at 21 times price to free cash flow. Compare that to a Facebook or an Amazon, closer to 30 times. Even Coca-Cola trades at 27 times free cash flow. So relative to the growth prospects, we still view it as very attractive.
We'll leave it there. Thanks so much.
Thank you.
Good to see you again, A.B. A.B. Mendez with Frost Investment Advisors.
On Wall Street today, the Nasdaq started this earnings-heavy week at a record, though the other indexes fell. The Dow Jones Industrial Average dropped 66 to 21,513. Nasdaq up 23 to an all-time high. The S&P 500 dipped 2. Domestic crude was higher after Saudi Arabia pledged to lower crude exports and Nigeria plans to limit its production. It was the first rise for oil in 3 sessions.
Relatively low oil prices have been good for the global economy. That's according to the International Monetary Fund, which said the world economy is strengthening. But the organization cut its forecast for U.S. economic growth, reflecting doubts about President Trump's ability to deliver on his planned tax cuts and infrastructure spending. The organization now calls for the economy to grow at a little bit more than 2% both this year and next.
Home prices hit a record even as sales stumbled. The National Association of Realtors says sales of existing homes retreated 1.8% in June. It's not for a lack of demand, it's supply. There are so few homes for sale that what is listed is going fast and at a high price. The median house price rose to a record of about $263,000 last month. In some cases, the houses aren't going, though, to the highest bidder, but to the buyer who can pay all cash. Diana Olick tells us why cash is king.
This home in the Dallas suburb of Coppell sold in less than a week. Not surprising to anyone who's out shopping for a home today.
Every house kind of goes pretty quick. You know, it's not on the market very long.
In fact, Laura Barnett, the agent showing the house, put this similar home on the market 3 weeks ago and got 22 offers. But she did not take the top one. With today's prices rising so fast, she took the cash offer because today's appraisals are not keeping up.
Yes, they are coming in low. They're putting a glass ceiling on our market.
Barnett says sellers don't want to risk a deal falling through due to financing, even if they have to take a little less money. The median price of a home sold in June hit a new high, according to the realtors, but days on market dropped dramatically. With homes going so quickly, appraisers can't keep up with the comparable sale prices.
They are being instructed that unless they have actual comps from past sales, that they cannot go on just the fact that they've been given multiple offers. They have to have comps to support it.
During the last housing boom, appraisers did just the opposite, often inflating prices because lenders wanted the deal done. And we all know what happened next. Lenders today are far more leery of home values and would rather err on the side of caution. That hits young mortgage-dependent buyers hardest.
The cash buyers always pushes out the first-time buyers who are more reliant on low down payment mortgages. And from sellers' perspective, they see all these different offerings and they say, well, if we go with cash, it solves much of the problem.
The problem for sellers, perhaps, but not for younger shoppers who long to be homeowners but are short on cash. For Nightly Business Report, I'm Diana Olick in Washington.
So are cash deals a sign that the housing market could be reaching a top? Aaron Terrazas is senior economist at Zillow, and he joins us now to discuss. You know, Aaron, Diana pointed out very clearly that a decade or so ago, the appraisals were sort of outstripping the real value. Here it may be the opposite. Are these prices rising so fast that the appraisers can't keep up with them? They're afraid. Is that a sign of a top?
So particularly in fast-moving markets like Dallas, you know, where home values are rising 3% in a quarter, it takes some time for those appraisals to hit kind of the transaction records. So, you know, certainly what's transacting today could be a little bit ahead of what appraisers are seeing.
But do you see that as the market topping out or not yet?
It's very different. When we talk about the market topping out, really people are worried about a repeat of what we saw a decade ago, kind of a drop in home values. And remember, that was driven by loose lending standards, which caused people to overpay and then the markets drop. We don't have loose lending standards today. By contrast, lending standards are still kind of really prudent. So it's impossible for the market to drop like it did a decade ago.
And this is evidence, I guess you would say, here, the case in Dallas, it is evidence that the lending standards are stricter. The appraisers are restraining themselves from just sort of green lighting a value based on the number of offers that are there.
That's correct, and it's frustrating, particularly for those first-time and entry-level buyers who just can't borrow as much as they would like. And it benefits people who have the cash to come to the table. That said, it does almost function like a natural brake on excess consumption and overtaking of risk. So in some ways, it's frustrating for a lot of people, but it does prevent us from repeating the mistakes we made a decade ago.
It does, but if you're selling your house and you have multiple offers above your asking price, which certainly is happening in our neck of the woods and in Dallas and other places, it's almost as though the appraiser is functioning, is skewing the market. In other words, the market is not regulating itself.
Well, the market is, the appraisers are slowing down the pace of market growth, and their job really is to provide this independent assessment of what a home is worth. They're not paid to make an appraisal in the interest of the seller nor the buyer. So, yes, their job is to put the brakes on excess.
What are the hottest markets in the country right now, and what are the major metros that aren't? Quickly.
So certainly the hottest markets are in the Northwest and the Southeast, places like Seattle and Portland. In the Southeast, you have Dallas and Orlando and Nashville. It's important to remember right now, kind of the labor market, particularly in those communities, is as strong as it's ever been. At the same time, interest rates are still at historic lows.
All right, Aaron, thanks very much. Aaron Terrazas with Zillow.
Thank you.
And still ahead, the Senate will move on health care tomorrow, but it's not clear what's going to happen.
Molina Health, an insurer that specializes in the Obamacare and Medicaid programs, reportedly plans to cut about 10% of its workforce. As first reported by Reuters, the company's decision came after it recently reported a quarterly loss related to the Affordable Care Act exchanges.
Senate Majority Leader Mitch McConnell said the Senate will vote tomorrow on whether to open debate on a health care bill. He added that the only way the Senate can actually consider ways to overhaul the current health care law is by opening debate in chamber. And the president is applying pressure to members of his own party.
To every member of the Senate, I say this: the American people have waited long enough. There's been enough talk and no action. Now is the time for action. We are here to solve problems for the people. Obamacare has broken our health care system. It's broken. It's collapsing. It's gone.
John Harwood joins us. He's covering the action in Washington. So, John, why is tomorrow's vote so important for the Republicans, and what do you think is going to happen?
Well, if they can't get 50 votes tomorrow, with a tie being broken by Vice President Mike Pence to take up the health care bill, that means the debate on the effort that Republicans have launched at the beginning of this year that got through the House to write a Republican-only health care bill will have failed. And at that point, they will have to turn to other options. Mitch McConnell has suggested working with Democrats on a bill to stabilize the marketplaces. It does not look good. A strategist familiar with McConnell's thinking told me today they do not expect the legislation to ultimately pass, but whether they can get 50 to begin the debate is something that we're just going to have to see when they lay the votes on the table tomorrow. But part of McConnell's thinking has been to make people take a stand, even if he's going to lose, so that everyone will have been forced to stake out a position and then they can move on if need be.
I assume John McCain will not be there to vote, John.
Assume not, although there's discussion by John Cornyn, the Senate Republican whip, of somehow getting John McCain flown back to Washington to vote. Now, if McCain shows up, you would think that would mean that they do have the votes, because it's hard to imagine his colleagues imposing on him in the wake of that surgery to return to Washington if they don't have the votes.
What about this Democrat plan called the Better Deal that was announced today? What's in it? What makes it better?
Well, Democrats have been facing pressure, Tyler, for seemingly only emphasizing their opposition to Trump rather than an affirmative agenda. So what they did was the Democratic caucuses in the House and Senate retreated. They came up with a plan, and what they came out with today was some familiar stuff and some new stuff. The familiar was a call for a big infrastructure plan they say will create jobs, calls for reducing Medicare prescription drug prices by letting the federal government negotiate with drug companies. The new point of emphasis for Democrats was a newly hawkish approach to reviewing corporate mergers, saying that one of the problems that consumers face is lack of competition, which drives up prices and reduces their opportunities.
Right. John, on that note, I know it's going to be another busy day tomorrow. We'll see you then. John Harwood in Washington.
Arconic, the American company that sold the panels at the center of that London apartment building fire a month or so ago, has some long-awaited positive news. It reported better than expected earnings, and it also raised its full-year outlook. Despite distancing itself from the fire, shareholders still have some concerns, and that sent the stock lower. Morgan Brennan has more.
It was a quarter packed with drama, yet Arconic managed to beat Wall Street's expectations. Analysts largely welcome the results, especially since the stock recently whipsawed on a parade of PR crises.
Arconic reported a strong second quarter earnings number, especially considering the noise surrounding the company's construction and aerospace engine businesses. However, we don't think the full year guidance range is enough to get investors excited.
Arconic, which was spun out of aluminum giant Alcoa last fall, has most recently come under scrutiny for its combustible cladding on Grenfell Tower, the London apartment building that caught fire in a deadly blaze. Speaking to analysts today, interim CEO David Hess called the fire a, quote, terrible tragedy. But he also stressed that Arconic was not involved in the design or installation of the broader insulation system used.
For our portion in the supply chain, we believe we've been compliant in the sale of our product.
Nonetheless, Arconic recently halted sales of the panels for a high-rise application, and one shareholder suit has already been filed. It's the latest incident to impact the maker of plane and auto parts, which was also blamed for the temporary grounding of Boeing's new hotly anticipated 737 MAX, just days before the jetliner's debut.
As a company coming out, as a new brand, it's definitely had some challenges here in its short lifespan of about 6 to 9 months.
Including finding a new CEO. After an abrupt departure in the midst of a bitter proxy fight with top shareholder Elliott Management.
And that'll likely be the next catalyst for the stock, is whoever they bring in and is able to put forward a more strategic plan for Arconic that's aerospace and automotive focused. I think that's going to be good for Arconic over the long term.
Meanwhile, after plunging more than 20% last month, shares of Arconic have largely regained ground, despite closing in the red today. For Nightly Business Report, I'm Morgan Brennan.
The health site WebMD is going private, and that's where we begin tonight's market focus. The private equity firm KKR is buying the online information company for nearly $3 billion. Under the deal, KKR will fold WebMD into its Internet Brands unit, which operates several other health-focused websites. WebMD shares rose nearly 20% to $66.10. Rising sales of Transformer action figures and Nerf toys helped Hasbro top profit and revenue estimates. Those gains were just enough to offset weaker demand for products like Easy Bake Ovens and Play School toys. Still, shares sold off, falling more than 9% to 105 even. And the retailer Hibbett Sports said that challenging sales trends would negatively impact its results. And as a result, the company expects same-store sales for the second quarter to fall 10%. Hibbett also sees that weakness weighing on its gross margins. Shares plunged 33% to $13.10. And Cal-Maine Foods posted a bigger-than-expected quarterly loss that missed estimates by a wide margin. The egg producer said lower customer selling prices and competition from egg alternative products hurt its results. Revenue also came in light. Cal-Maine shares were off 6% to $34.85.
Strong sales at Stanley Black & Decker helped sales and profit rise more than Wall Street expected. Those results prompted the company to raise its earnings guidance for the full year. Stanley says the integration of Craftsman, which it bought from Sears, is progressing and expects about $100 million a year in revenue initially from the Craftsman brand. Shares nonetheless off 2% at $143.70. The oil services giant Halliburton reported a stronger than expected rise in revenue as the company saw higher demand for pumping and well construction services here in the U.S. Halliburton also swung to a profit that beat expectations, but the company warned that growth in U.S. oil rigs is showing signs of plateauing, and that sent shares down 4% to $42.51. The apparel retailer VF Corp said strong demand online as well as internationally helped drive sales higher. The maker of the North Face and Wrangler jeans also reported profit that beat estimates by a penny. Shares were up 23 cents to $58.88. And Boeing said it expects solid demand for aircraft personnel over the next 2 decades. The aerospace and defense contractor said over the next 20 years, it sees demand for more than 1 million pilots and technicians to support the world's growing commercial airplane fleet. Boeing shares up a tick to $212.18.
And shares of Amazon rose today after a Wall Street analyst said the online retailer will one day be the most valuable company on the planet. In a note to clients, the analyst wrote that he sees few competitive threats to its core retail and marketplace businesses. The stock is now trading firmly above $1,000 a share. It still trails Apple, though, in market cap by a wide margin. Now the Amazon juggernaut may be setting its sights on a new target to disrupt. Bob Pisani takes a look.
It's not just retailers. Now there's a broader concern. Amazon has the potential to disrupt middlemen in general. So here's the issue. If you don't make the object you're selling, or you don't have some sort of intellectual property, then you're just a middleman, and you're increasingly more vulnerable. So Amazon is taking aim at middlemen in the whole industrial space and even beyond. In 2005, they bought a business called smallparts.com. In 2012, it was renamed Amazon Supply with the idea of supplying industrial and commercial customers. In 2015, it was rebranded again. This time it's called Amazon Business, and it's got a bigger goal: to be a supplier to the entire business-to-business community. Amazon Business now has 300,000 registered corporate buyers, according to Crain's, and past $1 billion in sales, according to Reuters. That's big. It's starting to impact industrial distributors like Fastenal and Grainger. They sell screws and pumps and tools and other parts for industrial America. Last week, Goldman Sachs urged investors to sell Grainger in a note, as well as Genuine Parts Company, which is a distributor of automotive replacement parts, because of their susceptibility to price competition and lower margins, particularly due to Amazon. They could even get more aggressive, pulling a Whole Foods deal in the industrial space, potentially. Last week, a Gabelli analyst said, quote, "We would not rule out an acquisition of Grainger by Amazon if such a deal were embraced by both parties." Amazon, for its part, had no comment. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Coming up in this world of oversharing on social media, why you may want to read the fine print on a new popular app. Shares of Snap, the owner of the popular messaging app Snapchat, hit a new low. Snap is also approaching the expiration of its so-called lockup period, which means it'll be the first time many company insiders can sell their shares following the IPO. But Snap also has another issue it is dealing with, and that would be privacy. Recently, its Snap Map has become a big worry for users, especially teenagers who may be sharing too much. Andrea Day has our story.
Oh, there's 2 of my friends hanging out right now.
See that Bitmoji? That's a friend on Snapchat. You can see exactly where they are, driving, listening to music, even playing tennis.
The app is very addictive. Every time you open it, it marks where you are.
It can also work like a breaking news feed, letting you pan around the globe and see what people are doing right now.
Where is she? She's in Sweden.
Hotspots show where big crowds are all snapping.
Oh, there's a protest.
And users are snapping it up.
People are getting more comfortable sharing more and more information.
And experts say it could become a powerful tool for advertisers. But does Map take sharing and connectivity too far? If you opt in, Snap shares your location with friends, down to the address. Attorney Michael Kasdan specializes in privacy.
There is that risk of real bad actors, someone stalking and someone being able to locate someone in the real world.
A concern for teenage users who may just download apps and not read the fine print.
A lot of people often don't look at it and don't really understand sort of the scope of what they're agreeing to.
And according to Kasdan, it's something businesses need to be aware of too.
Giving this much information to Snapchat itself allows them to really target our behavior in ways that are a step up from what they would be able to do without this type of location data.
If you turn it on, you can always opt out of the feature by turning it on ghost mode. But it's easy to forget to turn it off and wind up being tracked. GPS tracking apps like this are already on law enforcement's radar.
It creates almost kind of a flash mob mentality.
Former LAPD chief Michael Downing says showing where big crowds are in real time can be a security risk, especially after events like Manchester.
Soft targets are something that we are trying to defend against right now, not only on the inside of stadiums and arenas, but hardening the outside core, where you have less control.
According to Snapchat, quote, "The safety of our community is very important to us. With Snap Map, location sharing is off by default for all users and is completely optional. Snapchatters can choose exactly who they want to share their location with, if at all, and can change that setting at any time." But Kasdan says parents still need to be very aware of what their kids are doing. Teenagers might not be thinking too much about privacy, but just connecting with friends and doing what everyone else is doing. For Nightly Business Report, I'm Andrea Day.
And on that note, that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Mathisen. Thanks for me as well. Have a great evening, everybody, and we'll see you right back here tomorrow night.